I still have with me now Lagos studio Damilola Olupona, Financial Services Analyst at Chapel Hill Denham. Thank you so much, Damilola, for your time and sticking with us. Now we're looking at the likely play out of a retention loosening or a tightening of rates at this point in time. Like Dr. Muda Yusuf has made mention of, we've already pushed the increases to the limit, and this is a time to wait. You'll take.
Yes, we believe they'll keep the monetary policy parameters unchanged at the next meeting, as argument exists, for both hiking and loosening, interest rate. But for us at this time, given that they had raised, monetary policy rate, by 400 basis points, we think the best approach, would be to adopt a wait and see. We think the best approach, would be to adopt, a wait and see approach to allow the impact of the previous hike, to filter in the economy. And more importantly, if you look at the inflation numbers, which has been the major anchor of the hike in interest rate we've started seeing moderation in month-on-month inflation numbers, yes. Which would mean that going forward, we might see respite, to inflation, albeit we are still cautious, regarding future inflation numbers, as the flooding, we saw in November, and also the devastation to farming activities due to security concerns still pose upside risk, to inflation numbers going forward.
And this will definitely touch on the non-performing loan rate as well, the ratio. But also wrapping up the conversation for the lack of time now, we've saw the Q2 figures, which was positive. However, despite this positive trajectory, there are still concerns around economic contraction. We're also expecting the GDP figures for the third quarter to come out next week. What's your take on that?
Yeah, our take is that economic growth, will still remain positive, or largely supported by the non-oil sector of the economy, as the oil sector, has been largely impacted by lower crude oil production, which would mean that we might still see oil sector growth, still remain muted. But then we expect non-oil numbers to come in positive, largely supported by strong telecoms numbers. Manufacturing numbers are also expected to improve as well. So by and large, we still expect economic growth, to still remain very impressive.
The Debt Management Office is also raising a fresh new red flag at this point in time, saying that revenue generation capacity is also threatening our debt sustainability. Hence, government has to do more to raise revenues and reduce borrowings. How do you think we would wriggle through this situation?
We think we find ourselves in a very tough spot, especially if you factor in the fact that debt service revenue numbers, are somewhat elevated, very close to 90%, which is not sustainable. And a lot of that, had to do with the revenue leg. Revenue numbers, are falling short. If you look at January to June, oil revenue were 50% lower than what the budgeted numbers are. So like I mentioned before, if the federal government can do a lot, on the one hand in boosting crude oil production, we might start to see respite, to that number.
Has already come online.
Yeah. Or better still, they would have to do a lot in reducing the cost of borrowings as well.
Okay.